Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic I want to discuss with you retirement pension plans and give you a snapshot of kind of what is a retirement pension plan, what are kind of the individuals that are receiving retirement pension plans, and if you're not offered one through your current employer, how you can have access to a type of personalized retirement pension plan by using your existing assets, your existing 401ks, 403bs, IRAs, etc. So retirement pension plans in general, what happens is you work for a company, an individual will work for a company for X amount of years, and after those X amount of years are done, there's a calculation that essentially gets computed, and it says, okay, Mr. Client worked for the police department for 25 years, so then after that 25th year, he's now entitled to receive a lifetime stream of income, kind of like how Social Security works. You're going to, that person doesn't have to be 59 and a half. That person could be, in their 50s and their 40s, depending upon how long that length of service is. Sometimes the pension plans work more favorable if it's the length of service, and also if you wait out, till age 60, 62, 65, because that amount is going to be larger on a monthly basis to you for income. So the snapshot of a retirement pension plan is essentially you're working for a company, and that company is setting up a type of retirement account for you that will pay you lifetime income stream at a later date. And what that's known as is a defined benefit plan. Okay, they're defining exactly what your benefit's going to be, and this was something that was very common. You had in the 50s, the 60s, etc. Now, from that point, what happened was many companies, they had too much risk. When a company is defining exactly what your benefit is, and that means that they have to take a portion of how much they're making or how much your salary is, and they have to place that aside into a type of retirement account. Make sure that retirement account is going to keep growing and growing and growing, so that when it comes time for you to retire, they have to now determine how long is this individual going to live for, because obviously there's going to be X amount of payments that are coming out of this for that person's lifetime, and how exactly can they get specific growth on that account. So because of that is some sort of risk, now you have companies that they said, hey, listen, we used to offer you a defined benefit plan, that pension plan, but now for everybody else that's coming in that's new, we're going to change that to a defined contribution plan. Defined contribution plan, this was originally set up, it was they broke ground on the first implementation of these plans in 1974 through a program known as ERISA. And essentially what it did was it said, okay, well, rather than the employer, the company, take the risk for themselves, what they're going to do is now throw that risk on the actual employee, and they're saying, hey, listen, well, rather than set aside money for you, what we're going to do is we might give you like a match onto your 401k or match onto your 403b. So now that individual is trying to determine what their retirement bucket is going to grow to. So it goes by the contributions that the person is placing in there, and also possible matches from the employer, and how well that percentage return was, if it's tied to mutual funds or it's tied to some sort of financial entity, how well that rate of return is to grow this bucket. So individuals in the 80s, the 90s, they were placing more and more dollars into their retirement bucket, into their 401ks, into their IRAs, and it was what was determining whether or not this bucket was going to be larger at the end of the day or smaller at the end of the day, at the end of the year, was not only how much money they were placing in there, but also, most importantly, the percentage return that they received back. There are certain fees to set up with the defined contribution plans. There's certain advisors that would go and give you recommendations and charge you advisor fees. There's a whole slew of different things where people have different theories behind it on why they did that, why kind of the government came in there and set up these plans to basically throw the risk on the employee. One thing is it takes away the risk from the actual company. The second thing is it could also make advisors more money. It could make it more profitable, and now you have people that are placing more and more dollars into the market, hence going to grow the market. The problem that lies with that is individuals that have retirement pension plans, they're very happy because they understand when they hit, in their 60s or their 50s, whatever that is. If we take an example of somebody in their 60s, let's say that person takes an early Social Security, that means that they have a lifetime income stream that's coming in from Social Security at age 62. If they have a pension stream coming in as well, that's another lifetime income stream that just keeps getting paid to that individual year by year by year, month by month by month. So the combination of these two could be a very good thing if set up properly. Now, many times you have certain gaps where you might just have like an additional account such as a 401k or a type of IRA account, and there's a gap. Maybe the Social Security is covering you for $30,000, the pension income gives you another $30,000, but you need $75,000 per year to live off of for income. Well, then you have a gap of 15 grand there. So there's certain ways on how you could set up retirement income planning to make sure that you're sufficing that gap and you're leveraging your old 401ks, your old IRAs, your old retirement accounts to then place into a type of a specifically designed IRA contract that acts as a personal pension plan. And that's what this section over here talks about. Now, when it comes to the payouts with retirement pension plans, the most typical type of payout is going to be a single life payout, which means, let's say if you had Joe Smith went and he worked for a company for 25 years, and they said, okay, after that 25th year, Joe, you could either take a single life payout, which would be $40,000 a year, lifetime income, or you could take a joint payout, which would be $30,000 a year. The difference why this is a reduced benefit is because it will cover Joe and Mary, his spouse, as opposed to just covering Joe. So that's some things that people try to say, oh, well, my parents lived long, my grandparents lived long, I think I'm going to take the single life only option, but it could really bite them if they have a spouse in the mix as well. Another thing is something as simple as this example. If you get the joint payout, understand the company's incentive or the employer's incentive is going to be to push you towards that joint life payout. So they're going to say, hey, listen, it's worth it to take that $10,000 hit in this example to have that lifetime income stream, because if something happens to Joe, Mary could still receive $30,000 of income. And a way to kind of counteract that, making sure that you're netting a little bit more dollars, and it only works for a specific situation if the person's insurable. This individual could take the single life payment option, and then they could also take a life insurance policy out on Joe. What that does is, let's say that life insurance policy is $5,000 per year. Well, as opposed to this one where you're only netting $30,000, if you go and you take $5,000 and you pay for a lump sum life insurance death benefit, it's going to come to Mary completely tax-free. In this portion, you could take the single life payout, have a $5,000 life insurance policy or $2,000 life insurance policy. You're netting more and more dollars. So this one, you're netting $35,000 year by year by year. You're netting an additional $5 grand of profit. God forbid something happens to Joe, the income doesn't stop, because that's where the life insurance kicks in and pays Mary the tax-free death benefit in a lump sum. And then now she could start pulling out money, or you could throw that into a type of annuity product to pay lifetime income stream for Mary. So, there's a lot of different things on if you have a pension plan before you actually trigger how to take out that income. You just want to make sure that you see all the different options available. And that's one of the things that we help out with our company. It's 1-800-566-1002. We offer 24/7 customer service through a Fossey Financial Group. And the reason why we do that is because we get a lot of national volume in. If you're in a specific area, your specific age, you have a specific title, meaning you might be offered a pension plan through work, through a particular employee. The way that through a particular employer, the way that employer set up the plan could be completely different than 10 other individuals that call in. And one might be a federal employee, the other one might be for a private institution. Every single situation is going to be more and more unique. So you can't just blanket your goals or your program, your planning just to one type of scenario. You want to make sure that you're dealing with a specialist, and that's one of the things that we really try to help you out with. When it comes to retirement income planning, I briefly talked about it before, is individuals are now bent out of shape. They say, well, listen, I'm not offered a defined benefit plan. I'm not offered a pension plan anymore. What exactly do I do? And this kind of works for both people, individuals that have pension plans and individuals that don't have pension plans, because if somebody doesn't have a pension plan, but they work for a company, most likely they're offered some sort of qualified retirement account, such as that 401k. So what was happening was this individual, and just kind of excuse my horrible stick figure, drawing, what happens is this individual is working year by year by year, and he's placing his dollars into the retirement bucket. So like I said before, it's the amount of dollars that he's placing in there and the percentage return that is linked to that bucket, meaning like most likely it's going to be 90% of the time or higher, it's actually going to be linked to mutual funds. So this says, okay, if the mutual fund goes up, then the amount of money that I place into that bucket, the existing dollars in that bucket, and the percentage return is all going to increase that bucket. Now the downside to that is when the market goes down like it did in 2008, the average portfolio lost 57%. So these were individuals that were kept placing more and more dollars into a retirement bucket. They say, wow, I have $1 million, I'm ready to retire. And then they took that huge downward market crash. If you use the 57% example, that's a little bit extreme. You have some cases that are worse than that, some cases that are better than that. But if we're just using the average of 57%, that individual that had $1 million would have lost $570,000 that 1 year, and they didn't even take anything out of that account. So when it comes time to actually start pulling that money, let's say you hit 59.5 and now you're eligible to start pulling money from those buckets, how exactly can you go and place it into a type of pension income stream, something that would link kind of like how Social Security would pay you a lifetime income stream every single month or every single year, or how a pension plan pays you every single month, every single year. You could set up these 401ks, these defined contribution plans, and roll them over into a personalized defined benefit plan. And it's set up through a specifically designed IRA contract. So you could do that to bridge that gap, to make sure, if you have a specific type of income goal or income gap, you want to make sure that you're placing the smallest amount of dollars from those qualified plans to correlate to that exact goal. Meaning, if you have $500,000 sitting in your 401k account, but it only costs you $175,000 to accomplish that income goal, there's no reason why you should be placing more dollars into those types of IRA contracts, because you have certain negatives to it. You have certain restricted liquidity, things that counteract kind of that lifetime income stream that the company is guaranteeing to you. So at the end of the day, I just want this to be some food for thought. I want you to start thinking about some of your different options out there, and at any point in time, if this triggered anything that you really found interesting, feel free to give our 1-800 number a call. It's 1-800-566-1002. One of the things that we do very unique is something known as the Retire Sharp planning system. It's a proprietary software that we use, and we use proprietary strategies depending upon your area, depending upon your goals, that no other company has access to, where we could go through all the top carriers, all the top strategies. On average, we go through about 1,200 different carriers and carriers, contracts, and strategies for each individual situation. So when you give us a call, you say, hey, listen, I was interested in getting a retirement pension plan. I saw a video online. Could I please speak with a specialist? And that specialist is going to ask you a slew of questions. They're going to make you feel comfortable. First and foremost, they're going to educate you and not try to belittle you, saying, oh my God, how do you not know this? Unfortunately how advisors do, they try to strong arm you. We try to make sure that we're doing a very simple, methodical process, making sure that you're acclimated to it, that you could repeat back to us exactly what you have, exactly what your problem is, what your goals are, and seeing exactly if the solution might be best for you. And that's probably one of the reasons. Not only the national volume that we bring in, and we've had a very good, we've had very good reviews. We've never had complaints, and this is one of the things that I personally take pride in, is our A+ rated on the A+ rating on the Better Business Bureau. That just shows how well we've done for clients in previous years, and what we're currently doing year by year. So once again, my name is Derek Afasi. I want to thank you very much for watching this video. Please be on the lookout please make sure to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thank you so much, guys.